Good afternoon and good morning to everyone. Welcome to today's webinar, Energy Outlook and Product Updates. I'm Meng Na and I'll be your moderator today. This is the last of our 2020 webinar series hosted by Straits Financial Group. First, it is my great pleasure to introduce our guests today. Our first talk today on DME Market Development will be presented by Michelle Zhang. Michelle is the head of products and services serves at DME. She is responsible for planning and implementation of DME's business strategy, including increasing trading volume, facilitating distribution of DME Oman linked contracts, and further expanding the company's presence in Asia Pacific. Welcome, Michelle, for joining the panel today. Our next guest is Nicolas, Senior Director, Head of Energy Products, Asia Pacific, CME Group. Hi, Nicolas. Welcome to join us today. Nicolas is responsible for leading the firm's energy business throughout the Asia Pacific region, including strategy, marketing, and distribution of futures and options on CME Globex, the exchange's electronic trading platform, as well as the company's OTC energy clearing services through CME Clearport. He also works closely with Dubai Mercantile Exchange, CME Group's strategic partner, to cross-promote products and services. Nicolas will give us a talk on New York Mercantile Exchange Energy Market Development. Thank you, Nick, for joining us today. Our next guest is Erik Norland, Executive Director and Senior Economist of CME Group. Hi, Erik.
Hello.
Thank you very much for joining us today. Erik will give us a talk on macroeconomics of energy market. Erik is responsible for generating economic analysis on global financial markets by identifying emerging trends, evaluating economic factors, and forecasting their impact on CME Group and the company's business strategy, and upon those who trade in its various markets. He is also one of CME Group's spokespeople and on global economic, financial, and geopolitical conditions. Thank you, Erik, for joining us today. And our next speaker is Royston Huan, Senior Analyst Commodities, Refinitiv. Hi, Royston, for joining us. Hi.
Hi, thanks for having me.
Thank you. Royston will give a talk on fuel oil economics in Singapore. Royston joined Refinitiv in 2012 and currently focused on fuel oil markets in Asia, handling both its flows tracking into east of Suez and its pricing assessments. Previously in the company, he handled cross-barrel oil swaps pricing and designed the initial crude oil flows database from the bottom up. Outside of Refinitiv, he has over 5 years of direct risk management experience for oil trading and FI trading activities with a holistic understanding of market, credit, operational risks. Thank you again for joining us. Last but not least, let's welcome our in-house speaker, Kevin Tan, Executive Vice President at Straits Financial Group. Hi, Kevin. Kevin will give us an introduction of Straits Financial Energy Products. Kevin Tan is Executive Vice President of Straits Financial, and he looks after the OTC division. He also oversees the energy and iron ore practice at Straits. He has over 20 years of market experience, starting his career as an interest rates dealer at Bank of America. He moved into commodities market in the late 1990s and was the former managing director for ICAP Energy Singapore and also managing director of BGC Commodities Asia. Thank you all for joining us today. Okay, so Before starting our presentations, let me quickly go through the agenda for today. Here, let me share the screen. We will have two individual Q&A for Erik and Royston to address any related questions. Nicolas, Michelle, and Kevin will take questions at the end Q&A session. Now, without further ado, let's welcome our first speaker, Michelle, to give us a talk on DME market development. Okay, welcome, Michelle.
Okay, thanks, Mana, for the introduction. In my very short 5 minutes presentation, I will do a very quick intro of DME Oman and highlight the importance of Oman as a Middle East crude benchmark. More and more, we have been receiving questions and queries about Oman. Where can I see Oman prices? How do I trade Oman? Especially during this year when DME and RNE arbitrage window is widely open, and RNE had a historical delivery volume, which is driven by mostly the arbitrage opportunities with DME Oman. So here is who we are. You can see DME as part of CME Group's family, as the contracts listed on Globex and using CME Clearinghouse for clearing. And CME is our majority shareholder, and we do have 29% owned by the Oman Government Fund and 9% Dubai Holding. It makes sense because we set both Oman and Dubai national oil crude prices. There are four main crude benchmarks in the world. Everyone knows TI representing US crude, Brent for European crude, DME is DME Oman for Middle East sour crude, and in 2018, RNE launched a Shanghai crude representing the Chinese demand market. So all those crude benchmarks contract specs are very similar. Oman is very, very much similar to WTI, which is physical settlement, 1,000 barrels per lot, market open and close at the same time. However, 4:30 Singapore time or Beijing time, the Singapore marker is the most important price for Oman, as it sets the physical Oman official selling price. But if you are a refinery who wants to hedge and avoid the physical delivery, you can simply use Oman swaps. We call it calendar futures. It settles against DME Oman 4:30 p.m. marker every day. If you're already trading CME product, that means you are already set up on DME trading. So all the setup procedures are the same. Say, number one, you have to open up a clearing account with a clearing member, such as Straits Financial. And for trading, you can use your existing trading screens or our own trading screen, which is called CME Direct. To see DME prices, just ask your existing data vendors such as Reuters, Bloomberg, or even Straits Financial, your clearer, to provide you DME prices because we're using the same data distribution channel. So why DME is important? Why Oman is important benchmark for sour crude? It is because it representing 39% of the Middle Eastern crude heading to Asia market. As you know, Middle East crude they are all sold on OSP basis. So currently there are 5 Middle East producers are using Oman as part of their pricing formula, which include the biggest producer in Middle East, Saudi Arabia. Whereas Brent is a sweet crude, mostly being refined in Europe, and which is higher quality and more expensive. So Brent Oman spread should be positive, but this year Brent Oman was in the negative territory because demand in Europe collapsed due to the lockdown. But on the other hand, Asia has taken the lead in terms of recovery from COVID-19. So Oman was a very clear market leader during the price rebound in Q2. So now we can see global oil market will increasingly looking to Asian benchmark Oman crude for price direction. So Oman front-month trading happens during the 5 minutes window mostly, but Oman curve trading, the second month and third month trading, carries on after the window. So there will be enough volumes, if you look at the chart, to support you hedging demand. Here is the end of my presentation. Just please allow me to summarize DME Oman trading. As I mentioned earlier, CME and DME are using the same clearing house, so we could get 70 to 90% margin offset between CME and DME major energy contracts. And I added a next slide to show you that margin offset page, which is also on CME website. Using the same way you're trading CME, you will be able to trade DME. And DME market, same as CME products, DME markets open almost 24 hours a day. But for DME, liquidity is concentrating during Asian trading time. And this is a fast-moving liquid oil market that you can trade every day. And because we only close 3 days a year, Christmas, New Year, and Easter. So this is the margin page. Here is my the last page is my contact. Thank you very much for your time.
Thank you, Michelle, for an overview of DME energy products and a very detailed introduction of Oman contracts. I believe it will be very useful to investors in CME and DME exchange. Michelle will take questions at the end Q&A session. Next, let's welcome Nicolas to give us a talk on New York Mercantile Exchange Energy Market Development. Welcome, Nicolas.
Welcome, everyone. Can skip this one. Thank you very much for the opportunity to cover CME Group and NYMEX Energy Product. First, just a few reminders. So NYMEX is one of our 4 exchanges within the CME Group. Futures and options have certain risk and are not suited for all investors. And very important, none of the things that I will share today shall be perceived as a trade recommendation. So with that being said, the first thing I would like to mention today is the growing participation of international traders in the energy markets that we observe through the increasing volumes for WTI, Henry Hub, RBOB, and heating oil during non-US hours. This is a long-term trend that we observe for all our core products, liquid on the screen, and something that traders in the region should pay attention as it offers more trading opportunities. Starting with WTI, trading volumes outside of US hours reached 26% of the total volumes in March 2020, which was the highest share of total volumes on record. For Henry Hub trading futures during non-US hours grew to 8% of the total average daily volumes this year, up from a modest 3% 9 years ago. What it means is that now we have over 40,000 lots of natural gas were trading during non-US hours. 40,000 lots. To make a comparison, that's the equivalent of 100 LNG cargo. For gasoline, trading of RBOB during non-US hours has reached 11% of the overall volume this year, which is up 2%. So same thing, if we want to put this percentage in numbers, what it means is that RBOB trading during non-US hours now reach the equivalent of 20,000 lots or 20 million barrels, which is far more than the whole volumes of MOGAS 92, the reference of gasoline in Asia, trading during all day, not only US hours, and across all exchanges. So there is a lot of liquidity for RBOB for traders who are interested into this contract or need to hedge flow from outside the US. For heating oil, Trading outside of the US hours reached 13% earlier this year. And when we convert that into lots, that's the equivalent of 18,000 lots. Again, 18 million barrels, and that's only the volumes outside of US hours. So really a good growth among all our core products. We're observing as well the same trends on option, with the volumes of an increasing share, of WTI options trading during non-US hours. This growth has been led by electronic trading. Over 80% of WTI options are trading on screen, and we look to increase these numbers next year by promoting some of our new technology, including directed RFQs. So with that being said, let's now have a look to the modifications and a new product that we listed this year. I will start with the third line of this slide. End of last year, we listed the very first freight contract for LNG, which I will cover later on. In January, we had as well the first expiration of our Brent option without contrary instruction. What it means concretely is that now all in-the-money options are automatically exercised, while all out-of-the-money options are abandoned. This process makes the expirations way simpler. I take this opportunity to remind everyone that CME has lifted the exchange fees for Brent option, a code BZO, till the end of the year. In other words, we are not charging fee for Brent option. We made as well a couple of modifications to our WTI Houston futures by adding delivery location and tightening the grade that can be delivered. For those who are not familiar with WTI Houston, it's a futures contract physically delivered in Houston for a grade similar to WTI Midland, ready to export on a cargo. The other characteristic for WTI Houston, including contract size and listing cycle, are similar to WTI delivered at cash-in. We expanded our freight offering by adding a few routes, which I will detail in a minute. On crude and refine, we added a spread contract between syngas oil and the fuel 0.5 sulfur. So as a reminder, we offer a full set of contracts based on IMO 2020 fuels for Rotterdam, Houston, and Singapore Platts assessment, including our micro futures, which are for 10 metric ton. And last but not least, we listed the very first biofuel contract for used cooked oil, UCO, which I will describe in a moment. So as you can see, we have kept innovating and leading the markets with relevant contracts. On this slide, you can see some of the reference which are only available on the CME. So I already mentioned WTI Houston. For LNG, we are the only exchange clearing the Japanese crude cocktail, JCC. We are as well the only exchange listing MTBE, MTBE being a blending component for gasoline to enhance octane. We are as well the sole exchange to provide the route TC17, which is Jubail to Dar es Salaam for 35 KT of clean tankers. I already mentioned UCOME for biofuels, and on thermal coal, NYMEX is the only exchange listing ICI4 futures, which I will cover in a minute. So let's now dive into some of these products, and I will start with biofuel. So we already had an extensive list of contracts related to biofuels, either covered by our agricultural team, like ethanol or palm oil, or covered by the energy team. What we announced recently is the listing of 4 contracts for used cooking oil, UCO, and used cooked oil methyl ester, UCOME, which are the very first waste oil-based biofuels. So 2 references, UCOME from Argus and UCO from a price reporting agency called Prima, and 4 contracts because for each of those references, we listed both an outright contract and a spread versus gas allies. So why did we list this contract and why are they relevant for this region? So on the previous slide, I shared a list of contracts. The following chart is a simple reminder of the production process of biofuels. For biodiesel, vegetal oils or veg oil, like palm oil, soybean, rapeseed oil, are commonly used either after blending with methyl ester to produce respectively, if you use palm oil methyl ester, if you use soy oil methyl ester, and so on and so forth, or through a chemical process which involve methanol to produce fatty acid methyl ester, FAME being by far the largest biodiesel currently used in Europe, which in turn is the largest biodiesel market in the world. So for this traditional biofuel, production typically takes place on croplands that were previously used for other agriculture, such as growing food. And since this agricultural production is still needed, it may lead to the extension of agricultural land, including some area with high carbon stocks, such as forests. So in other words, the impact on the environment is not completely green. Waste oil-based fuel, on the other hand, recycled used vegetal oil. So to give a concrete example, some of the collectors are buying oils from McDonald's. When McDonald's cannot use this oil anymore to cook French fries, and they convert that into UCO. So this process obviously has a much lower impact on the environment. The European Union is implementing in 2021 new mandates on biofuel to limit FAME and encourage a larger use of UCOME. So all contracts are very timely. They are as well extremely relevant for Asia because most of the UCO, which is the feedstock to produce UCOME, is coming from Asia. So you have physical flow from Asia to Europe on UCO. Switching from biofuel to thermal coal, which is not an easy transition, I would like to share an update on ICI4. So we listed Argus Indonesian coal ICI4 back in 2018. ICI4 is a key reference for Indonesian coal, representing the price of sub-bituminous coal with a calorific value of 4,200 kilocalorie. ICI4 is really the barometer of Indonesian coal production, as this grade usually get exported to India and China, two key markets in the region. So since the launch of the contract, over 30 firms traded ICI4 futures, which is a very strong number to be for the coal trading community. More significantly, 2/3 of those firms are located in Asia, which result as well in the trading activity taking place during Asian hours, starting even during Singapore morning. This is a sharp contrast with any other coal derivative markets, which tends to be dominated by European traders, including Australian coal Newcastle. As an illustration, the following chart is a comparison of the time of execution for API2, which by far is the biggest coal derivative markets, and ICI4. As you can see, nearly 70% of ICI4 volumes are traded before 5 p.m. Singapore, which is really remarkable. In terms of client participation, it's a good mix of trading houses, end users, and producers, with clients representing firms from Southeast Asia, India, and China. Moving to freight, wet freight to be precise. We do not cover dry freight for the moment. We listed the very first LNG freight contracts based on the Baltic Exchange assessment for 3 key LNG routes. The route number 1, Gladstone to Tokyo. Number 2, which is Sabine Pass in the Gulf of Mexico to Northwest Europe. And the route 3, Sabine Pass to Tokyo through Panama Canal. So one route for the Pacific, one route cross Atlantic, and another one for the arbitrage. All three contracts are traded, and we are seeing increasing interests. Among the three routes, Sabine Pass to UK continent, the transatlantic route has been the most active this year, which somehow makes sense, as for most of the year, the key driver of LNG prices has been the arbitrage US to Europe. The last thing I would like to highlight on that is that this LNG contract complete our existing suite of products on natural gas and LNG, starting obviously with Henry Hub. But I'd like to take this opportunity to remind that we have a strong business on Platts JKM, as well as natural gas with TTF. TTF is even trading on screen on CME Direct. The other routes that I've already mentioned, because it's only available for clearing on CME, it's a TC17, so Jubail in Saudi Arabia to Dar es Salaam in East Africa. We listed this route following discussion with brokers in Singapore. As you know, the Middle East ramp up its refining capacity, while East Africa is structurally short of gasoline and diesel. So our TC17 contract is providing a useful hedging instrument for traders on this physical flow. More important to me, it's a great example of how CME works closely with traders and brokers in Singapore to add relevant contracts. And as we talk about freight, I like to mention other contracts widely used by shipping firms, bunker suppliers, and fuel traders, or micro fuel futures. So what are CME micro fuel contracts? Well, they are basically derivative instruments based on the standard price reference, either for high sulfur fuel oil or the IMO 2020 0.5% sulfur specification, but with a contract size which is only 10 metric tons, which offers much more granularity for hedging than the standard fuel oil futures, which are 1,000 metric tons, or the mini, which are 100 metric tons. Or microfuels are as well interesting because 10 metric ton is the size of the low sulfur fuel oil contract listed by INE. And so our micro are a nice instrument for traders looking for the arbitrage Platts versus INE. The last thing I would like to mention today is our current initiative on directed RFQ for LPG, so for propane. What is directed RFQ? DRFQ. It's a new technology available on CME Direct for privately negotiated transactions, in other words, for block trades. Using CME Direct or electronic platform, traders or broker can direct their request for quotes to selected parties that they choose among a list and have previously approved. These directed RFQ remain private, which means that the other counterparties in the market will not see them. Price negotiation and booking is done electronically. So this mechanism offers a couple of advantages: convenience to use an electronic platform instead of a chat, compliance, and it reduces the operational risk when booking the trades. We started promoting direct RFQ in the region to LPG traders, propane traders. So why this market? Because it's a small community who expressed interest in having new technology to facilitate their trade negotiation. So it's a work in progress, but more and more traders are getting signed up on CME Direct and join our trader directory, which is basically our contact database where traders can find and select their counterparts. So with this, I finish this presentation. I hope you find some of this information useful. If you have any question, we can cover that during the Q&A, or feel free to reach your CME account manager. Thank you very much for your time. And now I think it's time to hear from Erik Norland.
Yes, thank you very much, Nicolas. Very interesting presentation. I will I will, just talk a little bit about the macroeconomy and the sort of context that we find ourselves in, which is obviously a very challenged context, in particular for the oil markets and for anything that has to do with transportation, which we know is still very, very severely disrupted by the pandemic. Before we get into the presentation, I am required to show you both the short version as well as the longer and more detailed version of CME's disclaimers, which essentially say that because CME Group is an exchange operator and not a broker-dealer or an investment bank, we cannot offer you any kind of trading advice. So we have, in spite of this very sort of generally bad news period for the global economy, we have had, I think, an incredibly good piece of news coming out recently, which is the development of a number of new, very promising looking vaccines from Pfizer and BioNTech, from Moderna, and then most recently from AstraZeneca, although there seem to be maybe a few questions regarding that one. The vaccines, I think, generated what I would consider to be a very surprising response in the crude oil market. And you'll notice this chart is a little bit out of date. So I took WTI futures, West Texas, on November 6th, which was the closing price on the Friday before the first vaccines were sort of announced on Monday, November 9th. And what you can see in those initial few days after the initial, sort of 12 days, but including 2 weekends, so let's say 7 business days, after those announcements, is we had a much bigger price response from, say, like the December 2020, January 21, February 21, March 21 contracts than we had from the back contracts. It struck me as a very surprising reaction because most of these vaccines will not become widely available until at least April to July. So you're really looking at the second and third quarter before there's really any hope that a large portion of the world's population begins to be inoculated against against COVID-19. And yet, the strongest reaction was on the short end of the curve. And of course, we've seen this continue. If you were to look at the prices, say, this morning or at the close anyway yesterday, you would see some of these near contracts have gone up above $45 per barrel, like $46, $47 per barrel. Well, you haven't seen such a big move on the back contracts. That strikes me as an odd reaction. I would have expected it to be the opposite. I would have expected virtually no reaction at the short end of the curve, since only a small number of people, mainly medical professionals and extremely vulnerable people, will get the vaccines in the next, say, 4 months or so, but a bigger reaction further out. But that's not what happened, which I thought was kind of curious and interesting. The market for oil and for oil products still remains very, very unsettled. The implied volatility has come down a great deal. Implied volatility in crude futures is now down to around 40% or so, down to similar levels on ultra low sulfur diesel and gasoline. And that's very low compared to the spike it hit, obviously, earlier this year, but it's still relatively high. We're still trading at levels that were very common in 2015 and 2016 when the oil market was extremely unsettled, and still trading at levels not far from where we were at points towards the end of 2018 when the oil market also became very unsettled. So the market, I think, is still reflecting an enormous degree of uncertainty. And that uncertainty, of course, reflects the state of the global economy. I think when you look at GDP data, the way in which governments report it is often a quarter-on-quarter change, or maybe a year-on-year change. But I think that the quarter-on-quarter change is particularly confusing to look at, because if you looked at the Q3 GDPs, they showed incredible growth from Q2, 8% growth, or in the case of the US, like 22% annualized growth when you take that and you take it up to the fourth power. But when you look at the state of the economy, it's still very, very far down. US is still down about 4% from where it was a year ago. In the third quarter, the Euro area and Japan were also down around 4%, and the United Kingdom was down closer to 8%. The UK announced yesterday that the government announced that it expects an 11% contraction in GDP this year, which is truly mind-blowing. And of course, we know that these numbers are out of date because they're Q3. Everything kind of reopened to some extent in Q3, but as you know, many things are shutting down again in Q4. That's particularly true in Europe, slightly less true in the US, but even Japan, Korea, some other countries are now starting to take a little bit more restrictive steps as COVID starts to spread again in those countries as well. When it comes to evaluating the state of the economy, I have become a big fan of real-time economic data. And so you can get this from a variety of sources. None of these pieces of data are perfect or comprehensive, but the state of the restaurant industry, I think, is a very interesting thing to look at. It covers some of the bigger countries in Europe, like Germany and the UK. It covers 3 big countries in North America, so the USA, Canada, and Mexico. And it also covers Australia. And so you can see the incredible divergence between countries that either have it under control, like Australia, or thought they had it under control, like the UK and Germany during the summertime, and countries where it's much, much less under control, like the United States, Mexico, and Canada. And so you can see the impact of Europe's shutdown, taking restaurant activity down to around negative 98% in Germany compared to last year. Things are also sliding again in North America, which of course is bad news. When you look at more comprehensive data like US consumer spending, you see there too that US consumer spending really has not recovered. It's down around 8% year on year in terms of credit card spending from tracktherecovery.org. So spending has been rebounding a little bit on a month-to-month basis, but most of the rebound ended by the end of June. And in the last 4 months, things have been pretty stagnant. Moving on to things that are more directly relevant to the oil market, you see this very much with the TSA data. The Transportation Security Administration shows that the number of people boarding airplanes in the US is still down around 61% from last year. This is quite a bad number. And of course, this comes in a context of extremely high crude oil inventories. When you look at crude oil inventories, they're very, very high compared to where they were in 2017, 18, or 19. That same is true for ultra low sulfur diesel. Inventories there have been falling quite dramatically. So at least you're starting to see a correction in inventories, but they remain at a very high level. Gasoline inventories have also begun moving a little bit higher. They're not so far out of line. They actually came pretty much back in line with their historic levels by October, but they are starting to creep a little bit higher. This graph is actually 1 week out of date. So if you look at the most recent data, gasoline inventories actually took quite a big jump in the last week. So there's clearly a lot of supply on the market, a lot of supply being stored. And that's obviously difficult for prices. That said, the producers have done a pretty good job of cutting back production. US producers have cut production by about 20%. The same thing is true of OPEC plus Russia. You do occasionally see little fissures developing in OPEC, like we had this sort of threat from the United Arab Emirates to leave OPEC because they're not happy with their production quota. But that said, I do think that OPEC is going to kind of pull through here. I think they don't really have any choice. They had a big price war earlier this year with Russia. That obviously produced a pretty disastrous result. And I think the memories are still pretty fresh of the 2014 to 16 oil price collapse. Following that, OPEC really did adhere to its production quotas for the next 2 years. So I think that they'll probably be okay. Not every economy is doing as badly. China's economy has been doing pretty well. Obviously had a very, very bad first quarter. Second quarter growth improved to almost 3%. Third quarter growth improved to almost 5%. That's pretty good. I mean, it's good by most country standards, but it's pretty soft growth for China. But for China, though, I think the really relevant thing to the oil markets is not how the service economy is doing. I don't think the service economy matters so much to oil prices. I think what really matters in China is how the industrial sector is doing. The industrial sector in China has been doing very, very well. First of all, it never contracted. Even in the worst months like February and March, they were still showing slow growth year on year. More recently, those growth rates have picked up to around 7, 8, 9% year-on-year growth in the industrial economy. And so I really like this alternative measure called the Li Ka-Chun Index. It's composed a lot of electricity production and rail freight, and it has a very high correlation with where a variety of different commodities price themselves maybe 1 year later. And that's true of WTI, where it has a 0.46 correlation with WTI prices in 1 year's time. So when you compare this alternative measure of China's sort of industrial activity or industrial GDP, if you will, with the price of oil, you can see the price of oil often either coincides with it or leads it, or lags it rather. And so it tends to be a somewhat better estimate for where oil prices are going, I think, than the official GDP. But, while China's growth in many ways has been impressive, though, I think there are causes for concern. And so one cause for concern we've already seen, which is the weakness of China's export markets. Almost every country that China exports to has an economy that's doing very, very badly. Secondly, in that context, China has a strengthening currency. China's currency is strengthened against the US dollar. It's strengthened against almost every major currency, the rupee, the ruble, the real, almost every emerging market currency. So China is not only facing weak export markets, but it's also losing some competitiveness as well. There are a few currencies, a few important ones that have kept pace, like the yen and the euro. But for the most part, China's currency has been, in a small group of currencies, it's been going up. Another concern about China is, they've had this impressive economic rebound in the second and third quarter, but you can always ask, so how was that achieved? And so part of the way in which it was achieved was to massively increase China's level of debt. So since December 31, or I should say between December 31 and September 30th, China's government debt increased from 38 to 44% of GDP. That's a 6% rise. Household debt increased also by 6% of GDP. And non-financial corporate debt, which means the debt of all the corporations that are not banks, that increased by 18% of GDP. So China's debt levels have soared by 30% of GDP. And so that takes China's debt level up to an even higher level than what we see in the USA and in the Euro area. If you go back to the global financial crisis back in 2008, China achieved massive economic growth by going into debt then as well. But at that time, China's debt levels were much lower. And the problem is when you get to higher levels of debt, what happens is that additional borrowing often serves to fund the existing stock of debt. So a lot of this additional borrowing is being used to make coupon payments or to make principal payments on debt that was already borrowed in the past, rather than adding to new productive investment or new consumer spending or business spending. So we think it's going to have a smaller impact than it had last time, even if it has been beneficial. Of course, China is not alone in going deeply into debt. This is true in many other countries. Other countries are seeing their central banks essentially buying all of the excess debt. That's true in Japan, it's true in Europe, Canada, and in the United States. And so essentially the Federal Reserve and other central banks have massively expanded their balance sheets, and that has depressed the long-term level of interest rates. What they've been doing, though, is they've been buying all of the government debt that's being issued. So you saw China's debt levels soaring so far this year. Same thing is true for almost every other country. The US budget deficit was already growing coming into the pandemic. When Trump came into office, it was 2% of GDP. By the end of last year, because of his tax cuts and huge increases in government spending under President Trump, that now hit 5% of GDP by the end of last year. Now the budget deficit is at 15.8% of GDP, levels that we have not seen since the Second World War. And this is before Congress passes additional legislation, assuming it passes additional legislation. The House of Representatives voted on a measure to spend an additional $2.2 trillion. That would take the deficit to around 27% of GDP. The Senate has a more modest proposal of maybe 700 to 800 billion. That would add 3.5 to 4%, so that would push it to nearly 20% of GDP. And the U.S., of course, is not alone. You look at Italy, Germany, France, Japan, Australia, Spain, Korea. They're all spending money like there's no tomorrow. So essentially, we've created huge deficits, and the central banks are buying all of that debt. The central bank buying wave really crested at the time of the last stimulus package in the U.S. That stimulus package was passed at the end of March. The federal government issued $3 trillion in debt. The Federal Reserve bought $3 trillion in debt. The Federal Reserve didn't buy all of the treasuries. They bought some mortgages. They bought some corporate bonds. But the effect this had, I think, was quite remarkable as the Fed expanded its balance sheet. It sent technology stocks, gold and silver and Bitcoin and a few other things soaring. Since then, the Fed has slowed down, and all of these assets that went soaring after that balance sheet expansion have now started trading sideways. But I think it's important to point out that the Fed's balance sheet expansion does not create consumer price inflation. The reason for that is we have so much inequality, and the state of the labor market is so weak that people in the labor market are in no position to ask for higher wages. And without higher wages, you're not going to see consumer price inflation. But what the Fed has done and other central banks have done is they've created a huge amount of asset price inflation. They've depressed the bond yields, which means that bond prices went soaring, and that caused precious metals and technology stock prices to rise. In terms of its impact on the energy markets, I think the energy market impact is very counterintuitive. So as I mentioned, the Fed didn't only buy treasuries, they also bought corporate bonds. So when you look at what happened to the corporate bond spreads, um, outside of energy, they widened to almost 10% from 4% when the crisis hit. The energy sector briefly saw its bond yields go up to like 23, 24% over US Treasuries. Since the Federal Reserve stepped in and started buying corporate bonds through exchange traded funds or ETFs, we have seen a dramatic decline in yields for both non-energy and energy companies. And so I think what this is doing is you can see there's obviously a relationship between the level of energy spreads, which has now been inverted in this chart, and the level of oil prices. But what I think is remarkable in this chart is given the low level of oil prices, you might have expected much wider spreads. But their spreads are pretty narrow now because of the Fed buying. And so what this means is that oil companies still have access to credit. And so, in some ways, that's great for oil producers. It keeps them in business, but it also means that the oil market may have a harder time clearing. It may have a harder time shaking out weaker competitors. And when oil prices rebound, there'll be a lot of players in the market who are able to come back in very, very quickly and start producing oil again. So this may contribute to a problem of long-term oversupply. When you look at the US a little bit more in detail, you can see that we've had a plunge in rig counts, obviously. But one thing you notice here is this is not the first time rig counts have plunged. Rig counts crashed after 2014. So in 2015 and 2016, when oil prices dropped from around $100 a barrel to briefly as low as $26 per barrel, we saw rig counts drop very dramatically. But what happened during that time is you saw a productivity revolution. So this time rig counts have crashed and you're seeing another productivity revolution. So the rigs that are on are the most productive rigs, are the ones that are in the most productive fields. And of course, you have a lot of rigs that could be redeployed if oil prices rebound. The rig count, of course, tends to follow the price of oil. Given where the price of oil is, I think that it's not perhaps reasonable to expect that rig counts are going to increase anytime soon, but they can when oil prices rebound, as we've seen before in the past. So how long does it take? Well, typically in the Permian Basin, when oil prices begin to rise, it takes sort of on average maybe like 3 or 4 months for the rigs to come back on. And it takes about another 4 months or so after that for production to begin to rise. And so I think this is going to be very interesting. Once the vaccine is introduced and is widely adopted, which will hopefully be the case at some point next year, we could see a tremendous amount of pent-up demand taking demand much, much higher. But it's still going to take maybe 4 months to get the rigs back online, another 4 months to get production to rise after the rigs have come back in. And likewise, OPEC, if they maintain discipline, they may also be slow to increase production. That's why I think there's a really strong bullish case coming out of this for oil prices to rise. Yeah, just very briefly on natural gas, you've also seen sort of a stagnation in U.S. natural gas production, but at very, very high levels. There really hasn't been much of a drop in natural gas production in most regions, and there too, you're also seeing a continuation of the productivity revolution, where fewer numbers of rigs are able to produce more and more natural gas, just as they do for oil. So I have a little bit of time, I think, to take questions before we move on to the next speaker, if there are any questions for me.
Thank you, Erik, for your presentation. Yes, we have scheduled a short Q&A session for your presentation. Let's see if...
Good. Can I raise a question? This is Kevin.
Yes, please.
Hi, how are you again? Good to see you again.
Yes, good to see you.
Yeah, I really enjoy your presentation from last year, and this is like a continuation for me. That's when I first heard of the Li Keqiang Index. Thanks for introducing that.
Sure, you're welcome.
All right, so you said that the WTI LKQ Li Keqiang Index has a 0.46 correlation. Sorry, the slides was moving a bit too fast. This is over what sort of period?
Yeah, so this is calculated from 2005 to 2020. And so what I do is I take the level of the Li Keqiang index and I compare that to the price of oil over various lags. So we can actually, I'll flip back to that slide just a second, so everyone can take a little longer look at it. Sorry, I did go kind of quickly. Yeah, so on the left-hand chart here, you see the two of them graphed side by side. And then for the correlation, essentially, you just fixed the Li Keqiang index in place, and then you kind of roll the price level for WTI, and you can see what the correlation is. And the correlation kind of peaks out after 4 to 6 quarters. So in the previous chart where I just showed what the correlations were, I just took the 1-year point, so that's exactly here at the 4th quarter. But you can see it's kind of like a plateau. The correlation remains high from, highest maybe from 6 to 18 or 9 to 18 months forward. And that's, again, calculated over a 15-year period. It does seem to me, though, like the market's becoming a bit more sensitive to it. So in recent years, it seems to me maybe it's becoming more of a contemporaneous rather than a lagged correlation.
Mm-hmm. Okay, so I mean, what I could see is on the last quarter, we have seen a decisive uptick on the GDP estimates versus a slight in. I'm talking about the chart on the right side.
Oh, yeah, on the right, yes, yeah. So the right side basically also compares it to GDP as well. So this is a correlation chart on the right side. So it looks at the correlation. So, for example, the correlation of 0 is a correlation between Li Keqiang index today and the level of oil prices today. Then 1 quarter would be where it says 1, that would be Li Keqiang 3 months ago versus where oil prices are at the current time. So the GDP estimate, GDP also works for oil, but it doesn't work quite as well, which is the case for most commodities. And I think that's because China's official GDP, first of all, showed a remarkable lack of variability for many years, where it was always growing at 6 or 7%, rarely surprised by more than 1/10%. And then secondly, China's economy is also diversified. It's become much more of a service sector economy, much less reliant on exports. And the thing is, most services don't consume a lot of don't consume a lot of oil. So what's happening in terms of like people like me, for example, or you who are telecommuting to work, we don't really matter so much for oil consumption, but it's more like the industrial sector that really matters.
All right, thank you.
Are there any other questions?
Do we have more questions for Erik?
Mona, is anybody typing any questions?
I don't receive any questions from the audience. So if our audience are all clear of the presentation, Erik will sign off here.
All right. Thank you very much.
Thank you. Thank you, Erik, for joining us today. Thank you very much. Next, let's welcome our in-house speaker, Kevin Tan, to introduce Straits Financial and our energy products and strategies.
This one will be really quick. I'll take about 1/10 the time Erik took to finish. So Straits Financial, we are in our 10 years now. We are truly unique in the sense that we started off as a limited on a limited license, focusing just on commodities, and that's pretty much been our focus since. We are still predominantly commodities versus some of our competitors who are financial orientated and so on and so forth. We're also pretty much plugged in into where we are in Singapore, and we have offices around the world. We have a pretty big office, for example, in Chicago and in New York. We have a huge office in Shanghai as well. We have rep office in Jakarta, in Dubai, and given we're 10 years old, we're probably the only domestic Singapore broker that has grown in the last 10 years, that has emerged from scratch. We are also part of a much bigger group, CWT Limited, which is public listed in Hong Kong now. Was in Singapore, but now relisted in Hong Kong. So they are our parent company is one of the largest storage and logistics solutions firm in Southeast Asia. It also allows us essentially to tap on the same customer pool. The rationale for Straits essentially is that if our customer pool are using our warehouse, our storage, it does make sense for us to service them in other areas, including financial services. So that's where we came in, and our initial batch of customers were essentially clients of CWT, our parent, and that continued to be so. But we have expanded way beyond that now. We are now, on our 10th anniversary, we're now truly global. With client representation, not just initially was just largely Singapore. Now it's largely Asian, pan-Asian. Again, the strength that we rely on, it's we have the traditional voice business whereby you can call in and place an order, or we also provide platforms with our partners, which I'll show you shortly, on direct access into the exchanges. I think technology, it's still a very big focus for the whole industry, and for us, we do, however, try to cater ourselves to across group of customers. Some which are more comfortable in the traditional call in and placing orders, and the others is quick firepower via the click of a mouse. We do also have, we service individuals. They're not that predominant. Our business in Singapore, for example, is largely 70-80% institutional, if not 90% institutional. We also have got client referrals from some of our introducing brokers that we have arrangements with, that we support, from giving access to accounts, to the usual AML onboarding processes. Now, these are some of the products that we offer. So across the board, we try to break it out to the exchanges as what's more what all brokers do. We are members of the CME. We have access to essentially all the major exchanges that's traded: SGX, Shanghai, Japan, and DC, and so on and so forth. We like I said, we focus essentially largely commodities. We do have a growing financial practice, but still largely commodity focus. So we focus essentially on a few key areas. In the US, it's largely agricultural commodities. In Asia, energy and iron ore and FFA. We do have we have a new foreign exchange division that's coming along very well. So that we do spot and we do forwards. We have also recently started solutions evolving around pure voice, one area that which I focus on, which is the OTC sector. That has proven to be a huge growth sector for us. Year on year, I think that business alone has grown about 600-700% in terms of volume that we did. We have also expertise in terms of in our traditional metals area, an area that I think some of you might be involved in a talk yesterday that we held. So we have got a non-ferrous metal specialist in-house. We also have iron ore specialists in-house, and we have a bunch of energy guys that focus essentially on refined products. Now, the platforms I talked about earlier on were the usual, the CQG, the ATP platform. We have our own proprietary Straits Direct. So largely, whatever platform you're on, Stella, TT, whatnot, give us a call. We are able to connect. Again, this is a broad view of where we are located around the world. Now, before I hand you over to Royston, I'd just like to say that given that this is an energy talk, currently we do have a big push into the energy space. So in just on pure energy offering, what we do have is we have our huge, one of our biggest book is our energy clearing book. We have clients with funds with us that does clearing through us, execution exchanges, over-the-counter trades, voice broking, and so on and so forth. We do have a growing energy team as well, which I lead myself. Currently, we have 6 specialists on that team. We have nascent practice in New York as well that does essentially what they call OTC cleared trades that is done out from our New York office. It's currently a 2-man show. We intend to grow that practice a lot more. And going forward, we are going to set up in London a rep office, or through a joint venture whereby we will be able to present voice broking solutions out from London. Now, anyway, that's pretty much it. If you are an oil client, please just, I'll give you my contact numbers shortly, but just give me a call if you do have any energy requirements, whether from clearing to execution. We also offer trade services as well. Some of our clients are finance. Some of the clients that clear through us, we also offer them trade solutions as well in the physical space, from, for example, bulk breaking to some sort of forward financing. Anyway, just if you any get that category, just give me a call and I will get the trades finance specialist talk to you. Great, that's all. The next speaker is Royston. He's going to give us a very in-depth look into the fuel oil market, area which I myself specialize in. And Royston he is one of the within Singapore. We a lot of us call him up when we need a clarification on certain data, or we need his advice on what flows are and so on and so forth. He keeps an eye on all the bunker volume. He keeps eyes on the physical outflows. And he will take over from here.
Okay, thanks a lot, Kevin, for the very nice introduction. It's nice of you to say that. Very nice primer on Straits Financial. I'll be looking forward to what your team has in store in the future as well. Good afternoon, everyone. As Kevin mentioned, my name is Royston, and I'm here to share with you our views in Refinitiv on fuel oil balances in quite a detailed level in terms of the tanker, in terms of like tanker volumes, demand, supply, that kind of thing. So if you're interested in that, then stick around. Then, in particular, we'll be focusing very much on what were the expectations before IMO this year, taking a current sense check of the situation and in what way the market has changed, and perhaps what are the themes that we could focus on in our minds next year here in our little market east of Suez. Thank you for attending the session and your time, and thank you again, Straits Financial, for the opportunity to share our views as well. So before we get started proper, I just wanted to briefly introduce the Refinitiv Commodities Research Division. It started small in 2011, but has since grown quite quickly to the 150 strong team that we have at the moment. Within this division itself is about 40 analysts globally doing oil research alone. Our work also includes some heavy lifting when it comes to tanker vessel tracking. In Singapore, we also have a dedicated palm oil team. If you do have an Icon terminal, a lot of the stuff that we put out to our subscribers is through this section called the Commodities Document Library. In the search bar and icon located at the top left, you could type Commodities Document Library or just library, and it would get you there. From this set library, you can do a search for the product that you are interested in, for example, fuel oil, gas oil, and you'll be essentially able to get most of the materials that my team, what we write about. And you can even retrieve quite a bit historically if that interests you. So just some housekeeping pointers, or more accurately, these are the conventions that we'll be adopting throughout this presentation, is that we'll be focusing mainly on flows that impact the East of Suez market. And if it's not mentioned, our data would be coming from our own in-house assessments. And standard conversion, met ton per barrel conversion factors would be used, and we'll be discussing a little bit on fuel oil and some gas oil as well. So before this year, there was the expectation of a supply crunch on LSFO, VLSFO in particular, and the near evaporation of demand for high sulfur. But these two things didn't occur. And meanwhile, there was the COVID-19 pandemic that threw this complication this year. So how did fuel oil flows react? And are there any implications, any things that we can take away into next year? So in this presentation, we will try to explore some of these ideas. Just to get a sense check of the current global situation with regards to the pandemic, as of this week, it's been recorded slightly north of 55 million infections and about 1.5 million deaths across 214 countries. And of course, as we know, the peak effects of COVID translating to oil prices was felt the most in March, April, at least for this year to date. And WTI also had their historic trading at negative prices on April 20th, when crude dropped almost 300% and was further compounded with the price war between Saudi Arabia and Russia in early March.
Sorry, Royston, just one sec. The slides have all gone. Mona, can you see the slides? Mona?
I can see the slide.
Okay, can everyone see the slides?
Pictures.
Yeah,
I can see the slide. Yeah.
87 out of 130. Can you guys all see the slides?
I can't see the slides. It's all white.
Yeah, that's right. Me too.
Oh, okay. How about now? No, like.
The last slide was 84, and then 84 was the last slide, and then 85 onwards is all blank screen.
Yes. Yes.
Oh.
With my part, I can see all the slides. So maybe it's not downloaded on your laptop.
Okay, that's weird. Hang on. Okay. Well, anyway.
So some people can see it, some people can't, right? I think.
Do we just continue, and then I will check from another device?
Okay. Yeah, just just feel free to interrupt if it's.
Okay. It seems like slide 89 onwards is back, so there's just a few pages missing. So I think we can just talk through it if you don't mind.
No, not at all. Yeah. So I'm at the chart where there's Brent futures. Okay, so stop me if anything, okay? I was gonna say that the yeah, the main effects of the pandemic was felt the most during March, April, at least for the year so far. And TI, as mentioned, was trading at negative on April 20th, as we know. Also exacerbated by the price war between Saudi Arabia and Russia. So right now we are at the feedstock slide. Is correct? Okay. Okay, I will touch a little bit on feedstocks, the residual feedstock space, if everyone's okay with that. So right now, still on feedstocks. Since the last quarter, a larger percentage of fuel oil was headed directly to major refiners like China, India, and South Korea as the straight run and VGO, and likely for the refining pool. And this is what we have found out through our vessel tracking so far. Uptake from these three countries alone near doubled from around 700 KT a month last year to about 1.2 million a month for the current year to date. And this has been supportive, particularly for the high sulfur HSFO space. And however, into this quarter, right now, we see that such fuel oil volumes are being kept due to the very high sulfur to Dubai crack values, or just very high sulfur cracks in general, since the Dubai EFS is so flat at the moment. And currently, it is supply driven, we believe, with fuel oil shortage, collateral effect from the reduced runs that are happening regionally and globally, while overall fuel oil demand also has actually remained quite robust, as we will see later through the Singapore MPA bunker numbers. Straight run fuel oil still has its users, and it's now being directed to the blending pool instead, as opposed to being a refinery feed. So I'm at a chart where it shows cross barrel cracks right now, and you will recall that back last quarter last year, everyone was bullish VLSFO and bearish HSFO. And at that time, it no doubt made 380 spreads hit almost about $30 a barrel versus Dubai. So to put things in perspective, about $30 cheaper against sour Dubai crude at a time when VLSFO margins were quite literally on the top of the barrel. And books that were more focused on LSFO would have had to seek more heavy sweet crudes, which themselves were limited in supply, and therefore also increasing the demand of dated Brent peg crudes. Crudes like Pyrenees or Pyrenees, for example, or like or the Brazilian crudes. So right now we're still at the chart, but zoomed in further to the last few months of this year, where we see HSFO Dubai cracks commanding less than $1 discount. This was last week. It's widened a little bit, but it's still very high. And LSFO itself continues to be on the top of the barrel. So this chart was taken like last week when it was past 10, but right now it's already past $11. Current levels are actually at their highest in 6 months, as output cuts keep supplies tight, while the demand for bunker fuel at most ports are actually back at pre-pandemic levels, with the exception of, say, Fujairah, which has declined. This trend, we believe, is likely to stay for the rest of the year, the remaining few months, encouraging Asian refiners to prioritize VLSFO production. Currently, I'm showing the fuel oil arrivals in the top 4 destinations by KT basis. And in this chart, you will see that in terms of the import demand for this year, particularly between the first 3 quarters of this year, there was a larger percentage of fuel oil that was headed to major refining centers like South Korea, India, and China. And this has been consistently in excess of a million tons. This is changing this quarter, where the barrels continue to flow in the east of Suez. but a larger percentage of the volume is headed to Singapore instead, which is the traditional, more of the traditional bunker and blending hub for fuel. So in terms of the percentage makeup in this chart of these non-domestic import volumes that flowed into these 4 countries, South Korea, India, and China used to take in about 10% in early 2019, climbed to 20 to 30% the past 3 quarters, and now for this quarter makes up, again, less than 20% of all fuel oil imports east of Suez. A further breakdown on barrels arriving into these 3 countries showed that between last year and this year, there's also a 3% increase in barrels from Iraq, particularly from Khor El Zubair, and a 4% increase from Russia. Barrels which we believe are predominantly high sulfur in nature and very typical export regions for HSSR, high sulfur, straight run, and VGO. So I'm going to move on to the bunker market itself. So back in the last quarter, we made a sense check of the supply and demand balance for fuel oil, and we eventually concluded that there would be an estimated shortfall of about 2 to 3 million met tons a month, where shippers would have had to turn to more gas oil and diesel blend variants as alternative. The Singapore 10 ppm gas oil cash diffs were stuck in negative territory at minus 23 cents a barrel, while the product crack in Dubai remains below $5. It's gone up. It's actually now past $5, but this is another story for another time. We don't believe that it's fundamental, but more people beating up the market. But yeah, anyway, Asian market participants for gas oil have also had to cope with unenviable economics for storage, with the contango last week at least was about 20 cents a barrel, which is not enough carry, and now it's close to about 90 cent backwardation the past week. Asian refiners, besides those in China seeking to exhaust their export quotas, must once again think about reducing runs, as their product has no other outlets besides storage, which is already reaching tank top in many regions, including Singapore, I hear. One sign of this gas oil weakness, and conversely VLSFO strength in general, is the VLSFO 10 ppm gas oil spreads. And so far, VLSFO has remained for a very long time less than $20 per met ton discount to 10 ppm gas oil, and this is considered quite strong for the residual fuel. And only during the past week has it been seen to dip to about 23 half levels. So on the screen now is a chart on the fund months swaps time spreads by ton basis, where gas oil last week was at a weak contango of about 20 cents, while the LSFO and HSFO spaces are firmly backwardated. And actually only the past week we've seen gas oil flip into backwardation, but if you believe the reports that are published, it's a lot has to do with gas oil being lifted by the momentum provided by crude oil itself, and it's again, it's not so much fundamentally driven, at least in my opinion. So as you can see, if you can see the MPA bunker sales statistics on the screen now, for the past year, the market has adopted itself pretty quickly to a new normal at the beginning of the year, when IMO kicked in, where since January, more than 70% of the sales were already LSFO in nature. And it may be interesting to note that right now the year-to-date average for bunker sales in Singapore has actually increased and is now about 4.13 million tons a month. And it's interesting considering that this has happened after 3 consecutive years of declining volumes pre-COVID. Once you start to segregate the sales numbers by viscosity profile, certain things become more obvious, like with MDO sales near doubling, and with grades that are 180 CST or below, taking as much as 1 million met tons of bunker sales this month, which happened in March, by the way. So interestingly though, the viscosity profile of the majority of bunkers still remain quite resilient, with 380 CST continuing to make about 60 to 70% of total sales. And it hit a high of 77% in July. Flat prices that hit record lows in April encouraged further uptick in securing bunker volumes at lower prices by ship owners. Such an increase of this lower visco profile fuel suggests that more gas oil-like components are being fed into the blending pool to the tune of about 1 to 1.5 million tons a month. So yeah, the typical visco of like 10 ppm gas oil, for example, is about 4 CST. So setting a minimum vis of 30 CST for traded window cargoes is also encouraging of this. Also considering the current state of affairs where LSFO can fetch around $20 to $25 discount to 10 ppm. Refiners are still running broadly on lower than usual runs, and when they do, it will result in excess straight run being diverted from the refining pool and into blending instead, and it will continue to support bunker sales, in fact, out of Singapore, because countries still have their own local requirements for bunkers. But if their refineries are not running, then they would have to procure this from outside their own countries. The only exception is China, which is like actually increasing runs quite significantly. If we break down the Western up barrels into Singapore by load source, volumes that have traditionally been taken up by Rotterdam and Russia, for example, Kafkas, TWAPs, are now met more through countries like Brazil, Malta, or Algeria. So I just want to touch a little bit on Russian fuel exports, which currently are trending lower. They have been steadily reducing their production and exports of fuel, actually since the beginning of 2015, as refiners were incentivized by their government to upgrade in order to produce more high-value products such as gas oil and diesel. Exports of the fuel were heavily taxed, and this has actually created the desired effect. However, Russia still remains the world's largest producer, one of the world's largest producer and exporter of fuel, and most of it is still HSFO, high sulfur. Some Russian refineries have made efforts to adapt in anticipation for IMO then, and those are mostly the privately owned oil companies. But there are also a significant number of refineries that have not, and more notably, it's the assets that belong to state-owned companies such as Rosneft, which will continue to produce high quantities of HSFO. So yeah, perhaps what's more interesting is we can talk a little bit now on the impact of China and the bunker demand. On the right, you will also, of this chart, hopefully you can see, is also the export quotas assigned to the various state-owned refiners, except for Rongsheng. So there's always been like rumors and talks that there is the threat that market share is going to be taken away from Singapore to Zhoushan, but this hasn't happened on a significant scale yet. And based on the more recent developments, it seems like it's going to be a more symbiotic relationship, in my opinion. But anyway, Zhoushan continues to harbor ambitions to be their own bunker hub, which And because of this, we believe that there could be fundamental shifts. Though based on what we see now, they probably won't be drastic ones. But it's true that for the year to date, fuel oil imports, which had averaged about slightly north of 1 million tons last month, for this year, versus 1.2 million tons back last year. There's been a gradual 9 to 10% dip year on year in terms of like overall fuel oil imports into China outside their own country. So the current estimated LSFO production is pegged to be about 850 KT a month, also considering their 10 million met ton per year export quota. But buying will continue from other countries to meet any excess demand. And like everyone else, they would also be looking out for price arbitrage opportunities, for example. And since the INE LSFO futures contract got listed in June this year, there's been a very positive uptick by oil and gas players, with an average open interest right now of about 500 KT a month from January to April next year. An interesting note I would like to make is that the INE deliverable futures has their minimum vis set at 100 CST, while say in the Platts trading window, for example, the viscosity is set lower at about 30 CST. So yeah. And here, just looking at some of the dynamics, fuel oil imports into China actually spiked in May, June. From a pricing perspective, particularly when Zhoushan delivered bunkers fetch $10 more versus Singapore on their delivered basis. There was also a wide price spread between INE futures pricing and Platts Zhoushan pricing and this discrepancy was about $30 a met ton. However, now if we look at it currently at this time, the arbitrage appears firmly shut, with Zhoushan now fetching cheaper prices of about more than $10 discounts to Singapore delivered bunkers. This is also in line with our vessel tracking, where we are assessing some 500 to 700 KT of fuel imports for this quarter. We are quite confident that it will weigh in firmly less than 1 million met tons, unlike the previous months traditionally, which have always held kind of above 1 million met tons. We believe that the export quota that is allocated to the Chinese refiners will continue to last comfortably to the last months for this year, and would suggest that the various refiners with the license to do so will still try to meet those targets by the end of the year, in spite of the pandemic, for the concern that they might not be reallocated fresh quotas again into the following years, for example. So I'm going to talk about other outlets for fuel oil, just so that you can get a holistic picture of the fuel oil market. So I'm going to continue to move to demand absorbed by scrubbers and what's been going on in that space. Yeah. So BIMCO has most recently said that the scrubber-fitted main cargo carrying ships are about 2,600, and with a global fleet pegged at about 20,000 ships, scrubber-fitted vessels actually represent about less than 15% of that. And in October last year, we estimated that whatever was completed, the installations was about 2,500. In other words, there's been slow and steady, but minimal growth, and these figures are still very much lower than what was the initial expectation, which was about 4,000 ships, based on the initial feasibility study conducted by the IMO themselves. Various postponements of the installation has been triggered by various scenarios. It was first triggered by very high freight rates in Q4 last year, and now due to less than $100 high 5 spreads, the IMO 0.5 to HSFO spreads, which are currently about 65 to 75 at the moment. So that's still depressed, considering that the payback period on investment has been clearly extended, given that most ship owners were more prepared for a price spread within $100 to $200 range to make scrubber installation economical. And I mean, our view is that total scrubbers might remain less than 3,000 throughout the end of next year. In other words, what we are trying to say is that the high sulfur demand that is met by scrubbers alone could be capped to less than 300 million tons a month. But having said this, though, the latest bunker sales volume from MPA show that it's already been more than 25% of volumes, or slightly north of 1 million met tons, that have been comprising of high sulfur fuel. And so bunker sales in Singapore comprising HSFO has been slowly inching up at about 1-2% a month on average. And we believe that these sales are due to the increasing number of ships with scrubbers coming onto the market. So just to touch on more recent developments, Saudi Arabia has banned the discharging of wash water from the use of open loop scrubbers within its own waters, and therefore vessels with such scrubbers will be mandated to use VLSFO while calling on Saudi ports. Despite all these restrictions from the port states on the use of open loop scrubbers within their own port limits, almost 80% of current installations are still preferring the open loop type, as it is only in the open sea when a ship consumes the maximum amount of fuel when the engines are running at full sea speed. Another outlet of fuel is also the power gen, particularly about 180 CST. So I'm just going to touch very briefly on that as well, because it's been supporting the market as well and continues to do so. Power gen demand has been one focus of the HSFO market, particularly in the summer. It kickstarted where Saudi Arabia actually turned to domestic crude for its power gen needs at the expense of the fuel oil that it normally uses, as a result of the surplus domestic supplies in the wake of historic output cuts and plunging global demand. But despite importing overall less fuel, it turned to Singapore instead of its traditional supply sources in Europe. And what happened was that it actually provided support for Singapore HSFO, particularly for 380 CST from May to July, as buying in excess of 1 million tons occurred in the trading window, which was eventually sent to Saudi Arabia. Actually, the total volumes was about 1.5 million tons. Particularly for the West of Suez, on top of refiners already slashing their HSFO production, the pandemic has also ravaged demand for transportation and industrial fuels, leading to more output cuts from plants across Europe, as well as from its main fuel oil supplier, Russia. This is further compounded with the refreshed lockdowns in the region today. The 380 CST East-West has been range-bound for $10 to $15 since the middle of June, and actually hit an all-time low of about $4 a met ton versus, say, early this year when it hit about $30. Even currently, amid the regional run cuts, as I mentioned earlier, countries like Bangladesh, Saudi Arabia, and Pakistan continue to seek fuel oil, which is evident from their tenders, for its power gen needs even past the summer season. And their demand, which continues past summer, continues to be a viable support factor for fuel oil. So here in this 380 East-West spread chart, it's only recently has been hovering to about $20 per met ton levels, while it remained in the $10 to $15 per met ton range for several months prior. So this chart, as you can, if you're able to see, they have dipped they have dipped to slightly from 1.8 million tons last year to about 1.5 this year on average. But despite this, they have actually consistently bought more fuel outside of Saudi, which in turn has also consistently made up more than 50% of the total volumes imported this year. So now I just want to touch very briefly on the storage situation. So yeah, I mean, everyone was worried about IMO before the pandemic, right? And there was IMO as well. So inventory levels used to be healthier, obviously, from the previous months. But from second half of this year, it's already been trending lower due to the very high fuel oil time spread structure, disincentivizing storage. Right now in Singapore, it's already about 22 million barrels on landed tanks, less than the year-to-date average of about 24 million barrels. Floating storage capacity for the year so far has held steady within like the 5.5 to 6.5 million net ton range. On the right, you would be able to see the tankers that are around Singapore that are believed to contain like low sulfur or their components. Initially, I mean, still slated for the bunker market. If you add like the high sulfur floaters, it's probably you could add like about 500 KT to 800 KT more of this amount. So this is just capacity, but we believe that it's generally half filled. So the current stock level is about 3 to 3.5 million tons right now. So it's basically half full out of these 6 million tons that you see here. If you include IE stock data, the estimated residual fuel stocks will be at least 6.5 to 7.5 million tons for LSFO. And if you include HSFO in the mix, you can just add another million met tons to that, very broadly speaking. Fujairah's fuel oil storage is about 1 million met tons, which is actually at this year's lowest. And at one point in this year, it hit about 2 million met tons of inventory, which is very high for Fujairah. And in this picture in ARA, it's also been coming off record highs, which they also hit in the second quarter. So in conclusion, our take on the current market is this, that HSFO has been largely supported as many players exited the space. Trading the product has become niche, and with less suppliers with the means to provide such bunkers to vessels with open loop scrubbers. So that will continue to be supported. Scrubbing capacity will be expected to be capped at about 3 million tons a month into next year. But there are signs that HSFO is taking up a larger percentage of bunker sales at an average rate of about 1 to 2% a month. HSFO started strengthening this year when demand came from feedstock and power gen, those two outlets, and now cracks have been strengthened and runs have been cut to the point where it's less economical to be used as a feedstock. And we believe that the feedstock pool will limit refining feedstock volumes to about 500 KT to 1 million tons a month on average. However, fuel oil still has its uses for being a blend stock or being a cutter stock in the bunker sector. And at the same time, because of the run cuts everywhere, they're restricting the supply of fuel oil overall. So countries like Saudi, Pakistan, and Bangladesh continue to seek volumes outside their local supply. And these will continue to be support factors here in this region. And up volumes will also be supported to cater to these outlets. In the LSFO space, supply crunch is less, and it's comfortable to say there's always going to be ready supply with excess gas oil and straight run, which can be put into the blending pool. And stock draws have also occurred across the regions as well, and this will also tighten the market and sentiment. In spite of the backwardation of fuel oil, there still appears to be so there still continues to be continued interest in securing term floaters, particularly within the Singapore Straits, like Palapas. And for example, in Singapore shore tanks, the storage fees for fuel oil are heard to be higher versus, say, keeping tankage for distillates. So I heard at least one tank operator plans to switch from storing more gas oil volumes to fuel oil into next year. Current ex-wharf premiums for bunkers are actually within the single digits. So while it is supportive, right, it's not particularly rosy, and it's rather painting a more fundamentally balanced picture. We pack around 5 million met tons a month average for the year to date, versus some 5.5 last year. And this echoes the 9 to 10% dip in Chinese import volumes year on year. So Chinese fuel volumes are trimming in general, but it's not as drastic as some envision. But China's export quotas will still be kept at about 850 KT, while any incremental requirements continue to be pulled from other countries. Based on past data, we could look for price discrepancies between delivered Zhoushan and Singapore prices and INE and Platts Zhoushan delivered prices as potential signals on whether there's going to be more imports into China or not. And COVID-19, the pandemic could be merely delaying Zhoushan's ambitions. It's just a matter of time. However, the silver lining is in the actual delivery of the INE LSFO. In a gas oil-rich country like China, with its minimum VIS set at 100 CST, a trader may have to seek alternative delivery points like Singapore Fujairah to meet obligations, and therefore supporting the market within those regions. In fact, it just came out today that the INE said today that it signed an agreement with PetroChina to cooperate on overseas delivery for LSFO contract. So this would be the first time a Chinese futures contract would be deliverable outside China, which would also continue to boost liquidity for the contract and increase the pricing influence. We believe that based on factors like the above, that the market will actually continue to look balanced for fuel oil into the end of next year. So yeah, on the note of these parting thoughts, thank you for attending this session. I really hope you have found some of the things here informative. And if there's any questions, clarifications, if I can't answer them during the Q&A later, my contact is here on this slide, where you can add me on Icon Reuters Messenger, or you can just simply send me an email. So yeah, thank you again for the time.
Thank you, Royston, for providing your perspective on fuel oil trading. I believe this would be very informative and useful to the energy investors. And here we have arranged a short Q&A session for your presentation. Let's see if they have any questions. If panel speakers have any questions, we can also discuss. But now I don't see any questions coming from the audience. Our audience and our panel speakers all are clear with the presentations. And we are right on time. So let's say if we just skip the Q&A session and let's end our webinar here. So I would like to thank all our guest speakers today for joining and for your valuable input. Also thank all the audience for listening. This is the end of our 2020 webinar series, but surely as the pandemic has profoundly changed the way we live and work, we would expect more of the educative and interactive webinars featuring industry experts like you. So thank you all again and hope to see you again in our future webinars. Thank you.